Investors, the reward for investing in equities, it's a return. The risk is enduring bouts of downside volatility at times. Here's the data we previously shared from the S&P 500 and Charlie Biello of drawdowns and their frequency. Take a look at the chart. A minus 5% decline in the S&P 500 happens nearly every year. Minus 10% decline usually happens a bit over once every 18 months. Bear market decline, defined as minus 20%, happens a little over once every 4 years. Investors, if you invest long enough, expect at some point during your lifetime, the S&P 500 will lose over half its value, minus 50%. Given its rarity, let's call that one a generational decline. Investors, with these downturns in mind, we're going to add some details to last week's sneak peek at Oak Harvest's first half market outlook. This week, we are covering seasonality and cycles and how they might both be a tailwind at the beginning of the year, but a headwind throughout most of the mid-year. Our goal is not to be precisely accurate, but to give Oak Harvest clients and prospects an idea of what issues, as well as what opportunities our investment team thinks the first half of 2026 might present investors. Some years, like 2017, lack volatility. The bull strolls out of the gate, and your ride is over in 8 seconds. An investor looks back at the year, looks at their portfolio, and it looks like nothing eventful happened, but your portfolio stocks gained. More frequently, however, like last year, 2025, you look back and the markets and your investments endured a few bouts of downside volatility. Most years, even in strong bull markets, the bull tries to buck investors off its back onto the ground. Hopefully, investors at the end of the year are not gored and bloodied. For the early first half of 2026, our team is thinking the tailwinds for the current bull market extend, pushing the major indices higher in early first quarter. Historically, late December and very early first quarter seasonality is positive and on investor side. Here's the monthly return data chart from Merrill Lynch dating back to 1927. December tends to be a strong positive return month, but positive return is generally all back-end loaded. The second half of December stands out as the strongest second half month of the year, with most gains coming after the 15th trading day in December, which happens to be today. Here's the intra-month return chart from December from Market Gauge and Seeking Alpha. Longer time periods also look similar. You can see the first quarter of the year is historically strong, averaging about a 3% gain through April. This historically strong seasonality bodes well for returns in the next few months. Besides the much discussed positive seasonality of first quarter and fourth quarter stock performance, with recent strength in the S&P 500 from April through October 2025, registering 7 straight monthly gains with a 20% gain, this too has been historically a good forward return profile for investors. Historically, what comes after such a rally? Per data from RBC and the market stats average, S&P 500 records a positive return the next 3 months after a normal flat to down period of 4 to 6 weeks. Investors, this aligns with current market seasonality, as the S&P 500 has now gone nowhere since late October and would place the market in a position to re-accelerate higher after December option expiration starting next week, should history hold true to form. Investors, the above data would triangulate the S&P 500 to peak in late January-February period between, say, 7166 to 7266, up between 5 to 6% from where this was written, and up about 3 to 4% above previous all-time highs. These stronger returns appear not to be random events. These winning streaks have occurred when earnings are strong, liquidity is high, where major shifts are driving markets. Today, it's the AI CapEx spending, it's the easing financial conditions, and a resilient consumer. As always, history is not a guarantee. Investors, unfortunately, while seasonality is a tailwind for equities over the next few months, 2026 does usher in the dreaded second year of a presidential term. As we've discussed in previous election cycle pieces, the second year is historically the worst of a 4-year presidential cycle, with a mere 3.3% average return during the year and a positive return only 54% of the time since 1929. Here's the data from Charles Schwab and Ned Davis Research, as well as the monthly data from Merrill Lynch per Paul Ciana. Take a look at the data while you have a chance. Even if we look at more recent data from the 50s forward, the gains in president's second year from, say, 1950 through 2023 period have been only about 4.6% less than half the average annual S&P 500 gain of about 10%. Investors, remember, these are point-to-point returns at the start and at the end of the year, and they don't include intra-year highs and lows. This history, combined with our team's outlook for elevated volatility for most of 2026, makes the case for trying to be a little more tactical in one's investments in 2026. Throw in the presidential cycle equation, the market's history of testing a new Fed chairman during their first term, and investors should be wary of the middle few quarters of 2026. What am I talking about? I'm talking about, here's a list of recent FOMC chairs and what happened during their first 12 months in the lead. Lots of negative peak to trough numbers in this list. Before winding up this video, I'm sure a few viewers are wondering about this outlook and forecast might compare versus the prior dot-com investment cycle from 1995 through 2000. Specifically, how might the first half of 2026 play out if markets continue to move along a very similar path as the one we've laid out in previous videos the last 7 months since the current April 4th, 2025 tariff tantrum low overlaid with the rally in dot-com after October 8th, 1998, long-term capital management, bottom, and blow-up through the end of dot-com boom, which was in 2000. Investors, here's the updated overlay of those two time periods. Yes, still generally traveling along the same path in both price and time. That's good news and bad news sometime if it continues. A similar outcome prevailing in the first quarter would triangulate to over 7,200 plus in mid-first quarter of 2026 for the S&P 500, followed by a sharp fall-off into mid-year. I'm still finding this to be an amazing replay of investor behavior or just an amazing total coincidence, but it bears watching still as what events may slated to take place in early mid-year 2026, right around when a future low should show up if this cycle continues to replay. Yes, a new Fed chair appointment hits the FOMC. As one can see, there will be pushes and pulls in 2026, and we'll address more of these in each of our upcoming videos. For 2026, one of the things that's top of mind for our team is sustained, heightened market volatility. The good news is our investment team has experience in these types of volatile and bucking bull markets. Remember that elevated volatility also means elevated opportunity for longer-term investors. Historically, investors' biggest incremental returns come from investing when volatility is high, not when it's low. What does all this mean for you? Investors, our advice is for you to keep following our investment content on Oak Harvest website and our YouTube channels, and we'll be addressing more of our outlook in the next few weeks. And tune in to our live stream YouTube of our 2026 market outlook on January 29th. Investors, whether 2026 plays out as a bucking bull ride or something different, the entire Oak Harvest team is here for our clients, doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.